This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Arimus Oleg done on the what was the name of Princess Anne's horse that she rode when she represented Britain in the Montreal Olympics? Do they not teach you these things at school? No? The name is Goodwill. And that's the first of our complications that we're going to come to now. If you turn the page, we're on page 36. Goodwill. So far, the cost of the investment by the parent and the subsidiary has always equaled the value of the net assets of the subsidiary at date of acquisition. Just go back onto Arimus for a moment. Just go back onto Arimus, page 35. And you see that when Arimus acquired 100% of the shares of Oleg, Arimus paid 20,000. And if you look at the statement of financial position of Oleg at the top of page 35, shareholders' funds were equal to 20,000. That's 12,000 share capital and 8,000 retained earnings. On page 35. And if you go back to Rasa and Tatiana, you'll see the same. If you go back to Vytautas and Gediminas, you'll see the same, that we've always acquired 100%, and the share capital plus the retained earnings at date of acquisition was always the same as the amount that the parent company paid for their investment. In practice, this will not be so. And in the exam, I guarantee it will not be so. That in acquiring a controlling interest, the parent company will be paying more than the fair value of the net assets of the subsidiary at date of acquisition. Because they're not just buying the share capital, not just buying 100% of the shares, they're also buying control. And control is an intangible benefit. It's a right that the parent company is acquiring, the right to control the activities of the subsidiary company. So there is a premium going to be paid. If you ever follow the stock exchange, you'll find that when one company makes a bid to buy the shares of another company, they're always paying at a premium. They're paying in excess of what would you consider to be the fair value of the net assets of the subsidiary at the date of acquisition. And what they're buying then is not just there for the right to control, but we give it a name and it's called Goodwill. And it's working too. Working too is going to be the Goodwill calculation. So at the top of page 36, so far the cost of the investment has equaled the value of the identifiable net assets because a fundamental accounting equation. Go back to your F3 days. Go back to your your paper, I can't remember what number it was now, before they changed the numbers, go back to your basic accounting paper, and shareholders' funds equals net assets. And shareholders' funds is therefore made up of share capital plus the retained earnings plus any other reserves that the subsidiary may have as at date of acquisition, equals net assets. So we're buying not just 100% of the share capital and 100% of the retained earnings and 100% of the revaluation reserve and 100% of the share premium account. We're not just buying that, we're buying this additional, as yet unrecognised, additional asset of the subsidiary. We're buying the goodwill. So where the cost of the investment, the second bullet point on 36, where the cost of the investment is greater than the fair value of the net assets acquired, then we pay for something in addition, something more than the tangible net assets. This difference is goodwill. It's defined as future economic benefits arising from assets that are not capable of being individually identified and separately recognised. It's an asset which is unrecognised, and it's not an individual identifiable asset. Goodwill is an ethereal concept. We can't touch it, we can't see it, but it does exist. The accounting treatment of goodwill, the accounting treatment on acquisition of a subsidiary is governed by the IFRS, and it says that purchased goodwill should be capitalised, and in the same way as any asset, it needs to be considered as to its value. With a tangible non-current asset, we depreciate over its estimated useful life. With a tangible non-current asset, we depreciate over its estimated useful life. With an intangible non-current asset, we will amortize. We'll amortize a patent. We'll amortize a brand name. And goodwill is therefore slightly different. We used to amortize it. We used to write it off over its estimated useful life. Now we don't. According to IFRS 3 revised, the directors of the company, the parent company, must consider the value of the goodwill and carry out an annual impairment review. So whereas with TNCA we will depreciate, INCA, like for instance patents, trademarks, copyright, brands, all of those will be amortized. Comes from the French word mort. Mort means death in French. And so we will kill off these intangible non-current assets over their estimated useful life. It's the equivalent, for an intangible, it's the equivalent of depreciation for a tangible non-current asset. But the one exception is goodwill, which is an intangible non-current asset. It's not depreciated, it's not amortized, it is instead subjected to an annual impairment review. And insofar as this asset is impaired, it needs to be written down. It needs to, the amount of the impairment is charged against the year's income statement. But this builds up over a period of time. So over 3, 4, 5 separate years of annual impairment review, there will be a stage where, after the first year, where the accumulated impairment is now no longer the same as the annual impairment. Like depreciation. The accumulated depreciation is not the same as the annual depreciation because it's accumulated 1 year, added on to the next, added on to the next. And so we have this annual impairment review, and we will be building up the amount by which goodwill has been impaired since acquisition. And we need to remember that. So the accounting treatment of goodwill on acquisition shall be capitalised and subjected to an annual impairment review. It could be negative. It could be negative goodwill. In Aramis and Oleg, just go back a little bit, just go back that one page to page 35. If Aramis had acquired 100% of Oleg for $18,000, if Aramis had acquired the 100% of the share capital of Oleg for $18,000, together with the accumulated retained earnings at date of acquisition of $8,000, not only did we buy 12,000 shares, we also bought 8,000 retained earnings. We're buying 20,000's worth of shareholders' funds, and we're buying it for only 18,000. So we made a profit. It's called a bargain purchase. Which is what you've got at the moment, haven't you, in Stockman's? Jackass. Yeah, bargain purchases. So, I'm right, aren't I? Trackus is still going on at Stockman's. Trackus week, Trackus days. Am I talking nonsense here? You're looking at me very strangely. Trackus, yeah? It's a bargain purchase. You get things for less than their normal fair value. So where we pay less than the fair value of the identifiable net assets, we're making a bargain purchase. And that bargain purchase, I'm back again on page 36, the last point's there, negative goodwill, an acquirer should review. Aramis should review. At the first year end, the fair values of the Oleg net assets, to make sure that they are really the fair values of the Oleg net assets. And if we still have, as a result of this review, if we still have negative goodwill arising, if we still have a bargain purchase, then we will recognize that in the first available statement of income. It will be credited as a profit made on acquisition. Okay, page 37, we've got the example of Maruta and Liena. Maruta and Liena, working one. Just read the question, just see. We're preparing the consolidated statement of financial position. Goodwill will be an intangible non-current asset on the top part of the very first asset in the list of assets. So Maruta acquires the entire capital of Liena for $30,000. Statements of financial position of the two companies are as shown. Working one then, we've got Maruta and Liena, and it's 100% again. It very soon will not be 100%, so don't get frustrated by the fact that we keep having to do working one. Working two is goodwill. And it's calculated like this. It will develop. This is the very, very, very easy calculation of goodwill. It does change as we make a little bit more progress through the notes. It becomes a little bit more complicated. But it's always going to start with cost of investment. And the cost of the investment was $30,000. And what did Maruta buy when she spent this $30,000? Well, look at the Liena statement of financial position. We bought 100% of that 15,000 share capital, and we bought 100% of the retained earnings. We bought, therefore, the fair value of the net assets of Liena at date of acquisition. And the fair value of the net assets is there. It tells us the statements of financial position on that date were. And so we're going to compare this cost, 30,000, with the fair value of the subsidiary net assets at date of acquisition. Now, I've emphasized fair value. This is another complication that we're going to come to in the near future. But in all our examples so far, the fair value of the subsidiary net assets has been the same as the book value, the carrying value of the subsidiary net assets. And it is again in this case. In the case of Maruta and Liana, I could mess off. I could take out fair value and just put subsidiary net assets. But I want you to get used to the idea of fair value of subsidiary of net assets. Get used to the idea, because in an exam question there will be a fair value adjustment to make. This example, the subsidiary net assets at date of acquisition are the same as the carrying value of the net assets at date of acquisition. And they're made up of shares. We're buying the share capital, the shares of 15,000. We're buying retained earnings. At date of acquisition, the retained earnings were 5,000. So the fair value of the subsidiary net assets at date of acquisition are 20,000. And we're therefore paying a premium. We're spending more than the fair value of the subsidiary net assets. We're spending 10,000 in excess, and that therefore is our goodwill figure. That will be subjected to an annual impairment review, but because we're doing this consolidation as at date of acquisition, then there has been no time for that goodwill to be impaired. So consolidated statement of financial position now says, oh, I'm sorry, we should do working 3. I'm sorry, I should have done working 3. Maruta and Liana, per question, 36 and 5. What's the next line, Svetlana? The next line? Vita? Less the pre-acquisition. And the Liana retained earnings at date of acquisition were 5, because we're doing this as at the date of acquisition. So there are therefore no post-acquisition. In this example, it will not be the same in the exam. And our share of these non-post-acquisition is 100%, and 100% of nothing is nothing. So consolidated retained earnings are 36. Now we can move into the consolidated statement of financial position. Inca. Ten. Ask. Ask. You don't have a question? Super. Inca, 10. Other assets, 40 and 27. Shares, 25. Counter-arrears, working 3. 36. Current liabilities, 9 and 7. One final thing which I should have done is I should have referred that to working 2. Down the bottom of 37, net assets controlled by the group of 61. It's this 77 minus this 16. But that 77 and that 16 gives me shareholders' funds. And shareholders' funds equals net assets. So the net assets controlled by the group is that 61. And I think probably the last time, the share capital is always, only ever that of the parent company. That's not the last time that that will apply, it's just that it's hopefully the last time I say it.